This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead. With insight on the people, companies, and trends shaping today's complex economy. Plus, global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Massar and Tim Stenovec. Live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
A very good afternoon, everybody. Welcome to Bloomberg Businessweek Daily. We are across Bloomberg platforms, radio, TV, YouTube, and Bloomberg Originals. Well, we've got another deadline. As you know, we've been reporting this out throughout the day already, counting down when it comes to the U.S. war on Iran. And this is after President Trump renewed threats about attacks earlier. We'll get into that in just a moment. We've also got a market, Tim, it feels like, where investors are unsure about what happens next and kind of when it happens.
Yeah, I mean, I wouldn't say like searching for direction, but there's really not a lot of conviction with today's trade, at least on the equity side of things. We're down 0.3% on the S&P 500. To me, that doesn't indicate, and we're going to talk about this throughout the program, a big escalation. At least that's what the market's thinking. Yeah,
exactly. And almost an even split when you look at the S&P. A little bit more risk off. Almost 300 names in the S&P 500 are lower today. You mentioned crude, Tim. We're talking about, 113, almost 114 a barrel, just below it. We've been above 117. So we've definitely come off our highs of the session. And we just continue to follow, the headlines that we get from the White House and really out of the Middle East about where this war goes next.
We're going to have much more on the trade in just a minute, but also an update on where exactly we are on the war, for better or for worse. Jenny Welch is going to join us in just a minute with 8 scenarios that she lays out about what could happen. The base case, a little concerning, I think, for a lot of people.
8 scenarios. All right. Also, Jim Caron, CIO of Morgan Stanley Investment Management Portfolio Solutions Group, is going to be with us right here in studio on the macro and also being overweight the U.S. over Europe. Still, that is his position. And we're going to talk a lot more about kind of the investment environment. So much to get into with him.
Including private credit a little later in the program. We got a lot of private credit coming up on the program today. We're going to speak with Michael Gross, co-founder of SLR Capital Partners. He was one of the co-founders of Apollo, along with Leon Black and some others. We're going to get an update on private credit from him in just a minute.
And then we're going to talk AI. Remember when that was the only thing we seemed to talk about? TIAA's Chief Operating, I wanted to say TIAA-CREF because it was that for so long, but it hasn't
like 100 years.
It hasn't been for a long time too. The Chief Operating Information and Digital Officer over at TIAA is going to be with us. And we're going to talk about AI, how they're using it when it comes to finance. And Tim, something you brought up, this is a guest you brought to the table, and that is about AI and are we using it in the right way? It's something you and I talk about a lot.
Also try to figure out for my own selfish purposes, like what should we be doing here?
Could AI just write the script for us in
still trying
30 minutes perhaps?
Haven't been able to figure out how to do that. Somebody who has not yet been replaced by AI will never be replaced by AI. It's impossible. Is Amy Morris. She's standing by in the Bloomberg Businessweek studio. She's in for Charlie Pellet. Hey, Amy.
Hey, Tim. Thanks so much. Stocks paired losses. Oil now moving away from session highs. We check markets for you all day long. Here at Bloomberg, the S&P 500 down 0.3%. NASDAQ down about 0.5%. And the Dow down 0.4%. 10-year Treasury yield at 4.34%. The 2-year yield at 3.84%. WTI, it's up 1%, around $113 per barrel. And Brent crude is up 0.2%, right around $110 per barrel. Bitcoin is down 1.5% at $68,000. New York Fed President John Williams says his outlook for underlying price pressures in the U.S. is largely unchanged, despite his expectation that higher oil prices stemming from the war in Iran will boost overall inflation, telling Bloomberg TV that core inflation, that leaves out food and energy prices, should come down by the end of the year and that monetary policy is right where it should be. Intel joining Elon Musk's Terafab project, a chip manufacturing effort for Tesla, SpaceX, and XAI. Terafab aims to produce a huge amount of computing power each year. Intel's partnership would help accelerate it, and shares of Intel now 3% higher. Gilead Sciences agreed to buy private German biotech Tubulis in a deal worth up to $5 billion to boost its portfolio in cancer drug development. Shares of Gilead down less than 1%, and shares of Levi Strauss are more than 1% higher ahead of Levi's earnings reports after the closing bell. And a reminder that tomorrow You can tune in to Bloomberg Businessweek Daily to hear from Levi CEO Michelle Gass. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. It's a Bloomberg Business Flash. Let's go back to Bloomberg Businessweek Daily with Caron, Massar and Tim Stenovec.
All right, got it, Amy. Thank you so much. Well, stocks paring losses, oil moving away from session highs as traders weighed prospects for Iran to negotiate a deal to end the war. With President Donald Trump's deadline approaching, we've talked about this a lot, Tim.
Yeah, things looked a little bleaker this morning. President Trump took to social media at just after 8 a.m. Eastern time. Here's what he wrote, quote, "A whole civilization will die tonight, never to be brought back again. I don't want that to happen, but it probably will. However, now that we have complete and total regime change, where different, smarter, and less radicalized minds prevail, maybe something revolutionarily wonderful can happen. Who knows? We will find out tonight, one of the most important moments in the long and complex history of the world."
Which maybe explains in a big way the trade. We're going to get into that in just a moment. But first up, let's get an update on the president's deadline and the latest from the White House. Back with us is Bloomberg Economics Chief Geoeconomics Analyst Jennifer Welch. She is in the Bloomberg Washington, D.C. Bureau. Jenny, we lean on you a lot. We are still counting down to this 8 p.m. deadline, correct?
Yeah, we are still in a countdown. And even though there are conflicting reports right now about whether or not negotiations are still proceeding and whether or not Trump might be contemplating punting that deadline even further, I think all eyes are still expecting that we're likely to hear further from the president before we can officially call this.
You and the team have a great piece out, along with Becca Wasser, Jenny, about really the different options that are out there. Can you just give us your base case about what could actually happen?
Sure. So the four categories of options for what might happen this evening could include, first, that the two sides do end up reaching a ceasefire, or maybe just a partial ceasefire, or something that essentially is enough pretext to delay an attack. We see that as increasingly unlikely. It was always going to be a challenge, but especially given this tight timeline and now reports that Iran isn't even talking to the United States anymore, we think it's even less likely. That leads to a second category of options, which would be for President Trump to punt the deadline further. He's already delayed it twice. It's a self-imposed deadline. He has the ability to delay it further. And obviously, it's something that he is known to have done in the past, although we see that as possibly less likely because he's backed himself into a corner so much around not just this particular day, but a specific time. And the more he punts, the lower his credibility becomes. That leads to a third category of options, which are airstrikes. And there's sort of a spectrum of options. Trump could, for example, fully attempt to follow through on his threat of obliteration, massive airstrikes on not just Iranian military targets, but he's also threatened civilian infrastructure. Or he could choose to engage in more limited strikes, so following through on his threat, but with sort of an off-ramp in place. And then the final category of options would be another major U.S. military operation. That could look something like an attack on Kharg Island, Iran's major export hub, or along its coastline. We see that as relatively unlikely, just given the risk to U.S. forces that those operations would pose, but probably something that is still on the table at some point for President Trump.
Jen, just to wrap up, we've had folks come into this studio around the table and say this could go on till the end of June. I'm just curious what you're hearing at this point, especially as we try to assess the impact U.S. economy, global economy, and on global markets.
Our base case is that we're likely to see a near-term escalation, including starting possibly tonight, and that the conflict will then dip into what we call a lower intensity or a protracted conflict, that it won't be resolved anytime soon, and these disruptions, particularly in the Strait of Hormuz, might be with us for some time.
Okay, that's our reality and that's our life. Of course, though, we'll continue to track all of the headlines, and we know we'll be checking in with you. Jenny Welch, she's Bloomberg Economics Chief Geoeconomics Analyst, joining us from the Bloomberg DC Washington News Bureau.
You promised we get to financial markets, Carol. We always do, and that is where we are going right now. As we mentioned, stocks lower, oil higher, concern that the war in the Middle East is intensifying. Ahead of this deadline at 8 p.m. for Iran to agree to a ceasefire, and as Jenny mentioned, reopening that crucial Strait of Hormuz.
Let's get to it. Jim Caron's in the house, Chief Investment Officer of Portfolio Solutions over at Morgan Stanley Investment Management, their Portfolio Solutions Group, and he joins us, as we said, in studio. Welcome.
Good afternoon.
We kidded when you walked in. It's a shame there's nothing going on. Jenny just laid out a lot of different scenarios. How are you guys thinking about it in your group?
Look, I mean, the first thing that we're doing is taking a healthy dose of reality and recognize that we're managing a lot of noise right now. So we're jumping headline to headline. This person's having a conversation with this person and that person denies it. It's very, very noisy. So what we're trying to do is take a step back and look at trying to look at what some of the fundamentals are. The first place that we start is the initial conditions in the markets going into this war, which is that, the economy was relatively strong, a lot of fiscal stimulus, inflation was on the way down. The fiscal stimulus has put a lot of money in consumers' pockets just due to tax refunds. That means that the consumer can probably absorb some of the shock of higher energy prices for the near term. The question that you asked, Jenny, and the right question is, so how long does this last, right? What's the duration? What's the tipping point where this becomes something worse? We don't know what the answer to that is, but I do believe, though, that we are in a period here of negotiated escalation where there's going to likely be an escalation before we get to what Trump highlighted as a deadline somewhere between April 11th and April 18th. And there'll be a campaign of maximum pressure until, hopefully, a deal comes to the table. Now, what I think Iran believes and what the U.S. believes is that the longer we wait, the better deal that we're going to get. There's going to be a breaking point someplace. I don't think that's today, so I would fully expect there to be an amplification of some of the bombings and everything else that may go on. But the escalation is part of the negotiated endgame settlement process. So I think the markets are seeing this escalation, the exact same way that Jenny laid it out, is part of the endgame settlement process.
A lot to go with here. I want to start with what markets you think are pricing in right now, because if the president is correct in saying that at 8 p.m. tonight is the final deadline, and the U.S. could attack civilian infrastructure and essentially put Iran back to the Stone Age, as he's threatened in recent days, it doesn't seem like that the market is taking that threat seriously. Is that fair? So
the market pricing is, if you think of this as like a distribution, like a normal distribution, there's definitely a left tail where things can go really, really badly, and the markets may not be fully accounting for that. However, there's also a right tail where things could go a lot better and oil prices could come down, and then we can resume those initial conditions. What the market does is it finds the midpoint. So what we're really saying is that, yes, things could get materially worse, but there's also another tail out there where things could get a little bit better. So it's a good question that you're asking. Does the market fully anticipate this? On a probability distribution, on a weighted probability distribution, depending on how you think of these events and how much you weigh these events, yes, it is. It just means that the tails are pretty far. What that also tells me is that there could be a lot more volatility, because depending on which way it goes, it could be volatility to the downside, it could be volatility to the upside. So that's what the markets are effectively pricing in right now.
What's the longer term impact of all of this? And I guess I keep thinking about increased defense spending around the world. So then what isn't there money for? Or there's growing deficits, Jim. I also think about every nation seems to be thinking about their national security and whether that means water, energy, technology. And there's a cost of doing this on our home front. Yeah. What's the cost of that, and what's the impact of that?
So that's a great question. And this is exactly what our team is trying to think through, is the second and third order effects. The first order effect is oil prices are high and that hurts the consumer. Second, third, fourth order effects go much further down the line. So the cost ultimately it's not obviously just in the U.S., it's also in Europe as well. Mm-hmm. It's raw materials, it's agriculture, it's fertilizer, it's food, it's PVC pipes, it's all these shortages. I mean, I just saw today that used car prices are going back up again, and they've reached highest levels since 2023, like during the COVID pandemic, right? Because of chips and all of these various things. So when we're going
to have a conversation later about inflation, and they're saying it's more like 2022 versus some other inflation spikes.
Yeah, anyway. No, that's exactly right. So the way that we're thinking through this as an investment team, because that's what we're qualified to do, is we're starting to find out and trying to identify where those choke points might actually be that could have a positive impact on asset prices, and also where there could be a negative impact on asset prices. What does it do to the consumer? The consumer gets hurt. So if you had an expectation for GDP to grow at, say, 2.5% this year, it's got to be a lower number than that. How much lower? How much damage have we incurred, and what's the cost of that repair, and can it be repaired and over what time frame? What the markets are saying is that it's going to be tough in 2026. But if you look at the forward earnings forecasts going into 2027, they're still high. Analysts are always high. They will come down.
Right.
But does it come down to the point where earnings growth rates go to the low single digits, or do we stay around low double digits like 8, 9, 10, 11, 12%?
We don't know yet, though, do we?
We don't fully know yet, but what the market's trying to discount is it probably stays somewhere around like 10, 11% on average. Could be wrong.
Yeah.
But so far, we're going to get first quarter data, for earnings coming up. It's not, the month of March was bad, but, January and February were good. Right. So it's going to be a mixed message right now.
Yeah, JP Morgan, 1 week from today, we'll hear from JP Morgan. And then the other banks as well. Hey, okay, so this in the context of politics, because everything you're saying right now about affordability and questions about American consumers, I think is front and center when it comes to midterms. How do you think about that in the context of markets?
So the affordability is obviously it's a major issue, right? Gasoline prices moving higher. The consumer's going to feel that every single day, every time they fill up their car with gas. Look, the midterms are going to be tough. I mean, I'm hearing a lot of different people, very upset about what's going on. Who wouldn't be, right? But I think ultimately we have to see how this all ends, because there's another contingent of people that are saying, well, is it better to have a nuclear armed Iran, or is this the right, we had a date with this destiny at some point. We didn't know when that date was. The date's now. And so do you want to take this on right now, or is it a can kicking exercise where you just kick the can down the road and deal with it later? So I think the American people, once they get past the shock of higher gas prices and the dust settles on this, so to speak, ultimately it's going to be, the choice was a nuclear powered Iran, or nuclear, armed Iran with nuclear missiles, or something else. Which one would you have picked, and how much damage or how much pain did you have to take in the meantime? So it's a complicated question. So we'll see how it shakes out in the midterms, though.
Yeah, it's interesting. We've had a lot of folks say, listen, this was a war long overdue. This has been, tension, stress, dislike between the U.S. and Iran for a long time, as we all know. Does the U.S. come out stronger on the other side as a result of this? It's an interesting time in our history. Here we are, a quarter of a century, not a quarter of a century, 250 years old. But I just wonder how you think the role of the U.S.
I think we're going to have to wait 5 or 6 years to answer that question with accuracy. Right now, it seems pretty chaotic. Right now, it seems like the rules-based order is we're not following the rules in the rules-based order. We can make the argument that rules-based order really wouldn't tell us to do nothing right now, and is that the right solution too? So I honestly don't know the answer to that, and I think it'll be debated for decades going forward. I don't know that we're going to have an answer anytime soon. I certainly don't.
So do you have an answer in 40 seconds of what an investor should do in this environment? I know you like the U.S. over Europe. Just quickly, we'd be remiss not to ask.
Listen, I think that there were some great value opportunities in the value sector. Dividends, quality and defensive sectors are pretty good. Healthcare has been one of our biggest sectors. We think that benefits the most from AI over the long run. Love the healthcare sector, particularly in the managed care areas. That's really good. Technology, AI, and defense related, that's another area that I think is going to see exceptional growth. That's how we're positioning portfolios. Interesting.
Come back soon?
Absolutely.
We would love it. Great to have Jim Caron with us. He's Chief Investment Officer, Portfolio Solutions over at Morgan Stanley Investment Management Portfolio Solutions Group, joining us right here in studio.
Well, we continue our coverage of markets and asset classes. After this, we're going to turn once again to private capital. We got a deep dive with SLR Capital Partners Co-Founder, Michael Gross.
All right, everybody, you are listening and watching Bloomberg Business Week. We've got markets off our worst and best levels of this session. Stick around. We're back in just a moment.
The odds of a possible negotiated deal with Iran. We check the markets for you all day long here at Bloomberg. The S&P 500 is down 0.3%. NASDAQ down about 0.5%, and the Dow down about 0.4%. 10-year Treasury yield at 4.33%. The 2-year yield at 3.83%. NYMEX crude oil is up about 0.5%, around $113 a barrel. Brent crude is down about 0.25%, around $109 per barrel. Sources tell Bloomberg Bloomberg, Apple's first foldable phone is on track to arrive during the company's normal iPhone launch. That's later this year. They say the company is scheduled to introduce the foldable model in September alongside the iPhone 18 Pro and Pro Max. The product's price is expected to cross the $2,000 threshold. Shares of Apple almost 3% higher. Old Navy will reportedly launch a new format focused on athleisure called Old Navy Sport. That happens later this year. Old Navy owner Gap shares about 2% lower. And Delta Airlines will increase charges for checked bags by between $10 and $50 apiece as surging jet fuel prices prompt carriers to ramp up fees and ticket prices. Delta follows rivals United Airlines and JetBlue, which raised bag fees earlier this month. Delta shares now more than 1% lower. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. We return to Bloomberg Businessweek Daily with Caron, Massar and Tim Stenovec.
All right, Amy, thank you so much. Well, every day, highs and lows when it comes to the world of private markets and in particular private credit. Just today, we reported out how Blackstone raised $10 billion for its latest opportunistic credit fund, signaling sustained appetite from institutional investors to capitalize on the upheaval that we've been seeing in the private debt market. It's the firm's largest ever haul for opportunistic credit.
Meantime, a swelling wave of redemptions has driven Moody's ratings. This is an interesting one, to revise its outlook for private credit investment vehicles to negative after holding the line at stable for the last 2 years.
And they're talking about BDCs here. Hey, Our next guest was recently featured on the Bloomberg Intelligence Credit Edge podcast, hosted by James Crombie, Bloomberg News senior editor for credit. Great to have with us here in studios Michael Gross. He's co-founder of SLR Capital Partners. It's an independent asset manager. It's all about dealing with the U.S.-based middle market businesses and delivering really debt capital solutions to it. He's also one of the co-founders of Apollo Management, now Apollo Global Management. Welcome.
Thank you for having me. Much appreciated. Good to be here.
Yeah, great to have you here. I want to ask you, long kind of view here. When you guys started Apollo back in 1990, here we are 36 years later. What's changed when it comes to the private markets, other than just size?
Size, complexity, the solutions that private capital providers can provide. Back in 1990, all the commercial banks were providing senior debt financing, which is where the BDCs and private credit have picked up the slack since the GFC. So back in 1990, none of us were doing senior secured financing. We were all doing junior type capital, whether it's equity or mezzanine or sub debt. Today, the private credit world has evolved to the point where it's kind of taken over the senior secured market because banks have been forced to exit because of increased regulation.
Good or bad? Was that a good thing? Great for the growth of an industry, but what's your take?
Kind of depends who you are.
Yeah.
It's interesting if you think.
Explain that.
So if you think about the explosion that's taken place in private credit over the last 5 years, there's been $250 billion raised for these non-traded BDCs. Question: is that a good thing or a bad thing? And as I think about private credit, there's kind of three very important constituents. There's the borrowers who are borrowing from people ourselves. There's the asset managers like ourselves who are raising this money and investing it. And then there's the investors. So is this increased scale good for certain people? It's certainly good for the borrowers because they've had increased leverage with all the capital that's been raised to kind of get very advantaged terms. It's certainly been very powerful for the asset managers, the public asset managers in particular, because it's fee generating. But arguably, is it good for investors? Is this increased scale good? Is it improving returns? I would argue that it's not, that the need to put out all this capital in a relatively short period of time has put pressure on returns. And so yields have come down over the last several years, not because of interest rates coming down, because spreads compress and because of all the increased competition.
Are these just growing pains?
Look, I think our industry is here to stay. So the answer is yes, it's growing pains, but it's also a question of kind of where the right incentives are. Our job as an investment manager is to find the best risk reward for investors and not just grow for growth's sake.
You made an interesting comment moments ago where you talked about the type of lending that has gone to private credit in recent years as a result of banks not being able to do it because of the regulatory environment. I think for a lot of people, hearing that on itself might be a reason for concern. It's a asset class or an area of the market that doesn't have the same transparency, the same regulation as a traditional quote unquote big bank. Does it need to be regulated in a different way?
I personally don't think so, because if you think about where people are concerned about risk, it's systemic risk, it's too much leverage in the system. Private BDCs, private credit funds, public BDCs are not levered more than 1 to 1.5 to 1. Banks are levered 10 to 1. CLOs are levered 9 to 1. So there's not a bunch of systemic risk in the system where a series of defaults is going to create a downfall. So I personally don't think there needs to be increased regulation.
Michael, is it just as simple, like playing off of what Tim said about growing pains? Is it just a case that it became too big and too much money chasing deals, and so it leads to maybe deals that maybe shouldn't be done and that kind of thing?
It's too much money raised too fast, having to get invested.
Yeah.
And what that's created is significant competition, such that the private equity sponsors, who are the primary issuers of this debt on behalf of their portfolio companies, have increased leverage over the debt capital providers. So they can go to them and say, if I'm going to give you my loan or let you finance my company, you're going to have to accept a lower rate, a higher leverage ratio, and less covenants. And so that, I think, has relaxed underwriting standards and has potential risk going forward of increased defaults and increased losses given defaults.
There's things going on to macro, and I just want to throw in a couple of headlines just because they're crossing the Bloomberg, whether it relates to what we're talking about, but I just want to bring them to us. PIMCO weighing $14 billion debt deal for Oracle data center, so that plays into the AI. And then we have dated Brent oil price hitting a record of $144.42 a barrel. There are macro issues.
Those things not unrelated to what's happening in private credit.
But we think, no, exactly. Like I think about artificial intelligence. We've talked so much about the SaaS world. Like, so roll those in, and how that has also been major factors, or they have been major factors.
So the macro factors can definitely have an impact on performance. If we're in a world where oil's gonna be 150 for a period of time, that's gonna have a tremendous impact on the economy. And even
not just private credit, but
exactly on the economy. But because private credit, these are levered companies, that impact is magnified. And so companies that were created 3-4 years ago when rates were zero, and companies were leveraged 6 or 7 times, that haven't grown to date to support those capital structures, are even more at risk because of these macro factors. I think it's very important within private credit today to focus on areas that may be more immune from that, primarily like asset-based lending. Lending against hard assets as opposed to against cash flows that are more volatile.
Well, that's a big category. So sort of dive into that a little bit for us and where you are finding opportunities.
We beginning in 2009, coming out of the great financial crisis, identified the fact that banks were being forced to exit not only cash flow lending, but asset-based lending. So we began building out a series of strategies, a series of infrastructure to support asset-based lending strategies like lending against receivables, factoring businesses, lending against inventory, lending to other commercial lenders against their portfolios, where we can do highly structured transactions, lend against hard assets that we can then monitor on a daily basis and protect ourselves.
Figure out values, right? You actually know what you're investing in.
Exactly, because we tend to be the sole lender to these companies. So the control we have is tremendous. The documents allow us to go in on a monthly, weekly basis and adjust the collateral value if we think there's a diminution of value, for example.
We'll go there, because I think one of the things we talk so much about with private credit is transparency or lack of transparency. But as an investor or doing a deal, how much are you able to look into the investment itself? How often, how regular? And does every shop do it differently?
Every shop does it differently. I think because we primarily view this business as an investment business and not an asset gathering business, we're extremely hands-on. So when we make an asset-based loan, we do a field audit. We send people to the field, we verify the existence of the inventory, we value it. We send people to the field, we value that these receivables exist. There's been a lot of talk about First Brands and Tricolor and those frauds. Those are all avoidable. Had people done the work to verify the assets and were they in control of the documentation and been the sole lender to these companies, those things wouldn't have happened. And so what we do is all our transactions are directly originated with a counterparty. We do direct due diligence. Then on an ongoing basis, we're directly monitoring it on a weekly and monthly basis to ensure that our assets are being covered.
Which makes you wonder if that's where regulation should be, that there is some, I don't know, like some
It's a hard thing to regulate.
Yeah.
I mean, it's a hard thing to do. But the good news for us is that, again, back to the theme, commercial banks continue to be forced to kind of downsize that part of the business because the capital charge to carry those types of loans is very high, whereas we as an unregulated entity don't have those capital charges.
When you hear people say they're worried about contagion from this asset class, sparking issues in other asset classes, you're shaking your head. You don't see it happening.
I don't see it because if you think about it, people like JP Morgan, Wells Fargo are big lenders to people like ourselves. They hold billions and billions of dollars.
Yeah.
But they're lending at 50 cents on the dollar against a portfolio of senior secured loans. So the risk they're taking is fairly de minimis. And if you look back historically, no one has ever lost a dollar lending to a private credit fund or a public BDC or private BDC. Why? Because the regulatory environment for BDCs is such that you can't lever them more than 2 to 1. Mm-hmm. So there's already that very important check and balance in place to kind of prevent that type of contagion.
So what do you say to investors? Like we talk about, 40% of investors wanting out of certain funds. I'm just curious what you make of that. And then what went wrong? Did somebody, as our James Crombie, and I know you've talked with him, he says, look at that first page. It tells you that these things aren't that liquid. Yeah. So who's at fault?
So a couple of comments. And one thing I've learned from 40 years of investing in private equity and private credit is things are never as good as they look. And things are never as bad as they look. So on the way up, when this $250 billion was raised, things weren't necessarily that great. A lot of money to be put out. But people went and attracted significant retail dollars. It was fully disclosed that the structures were semi-liquid, that you had 5% restrictions, which was frankly is the right thing to do. Mm-hmm. But it's painful on the way down. And what's happened is the primarily people who are looking for redemptions are retail. It's not institutional. We raise money both retail and institutional. We're still seeing tremendous demand institutionally for private credit. Why? Because you hit on it earlier, Blackstone just raised $10 billion to be opportunistic. Well, this is a great environment to possibly invest in because capital is pulling back. Mm-hmm. That's going to put pressure on yields the wrong way for borrowers and the right way for us as investors. We view that dislocation as a good thing, provided you have liquidity to take advantage of it.
So potentially a good time to launch new BDCs just quickly, right?
Or to be involved in BDCs that are not fully ramped and have the dry powder to take advantage of this cycle and not be embedded with kind of older vintage investments.
So appreciate. I hope we can lure you back here.
Love to.
We would love it.
Appreciate your time.
Yeah, we appreciate your time. Michael Gross, co-founder of SLR Capital Partners. When we come back from one major narrative, private credit, to another, we talk about AI and its ever-growing presence in finance. We're back in a moment.
It's 2:40 on Wall Street. I'm Amy Morris. Stocks fell and oil rose on concerns that the war in the Middle East is intensifying. We do check markets for you all day long here at Bloomberg. The S&P 500 is down 0.4%. NASDAQ down 0.7%. And the Dow down about 0.5%. The 10-year Treasury yield at 4.33%. The 2-year yield at 3.83%. NYMEX crude oil is 1.3% higher, around $114 a barrel. Brent crude still around $109 a barrel, about 0.3% lower. And Bitcoin is down about 2%, around $68,000. PIMCO now looking at a $14 billion debt deal to build a massive Oracle data center in Michigan, talking with Bank of America for what would be PIMCO's second jumbo financing for a data center within the past year. Oracle shares 2% lower. Anthropic says its revenue run rate has now topped $30 billion, up from $9 billion at the end of 2025. The AI startup said that demand for its Claude services accelerated this year. More than 1,000 business customers spending more than $1 million on an annual basis. That figure more than doubling since February. Billionaire activist Bill Ackman has proposed a bid for Universal Music Group to increase returns on one of his hedge fund's biggest holdings. UMG is the world's largest music company, gaining 11% now, the most in more than 3 years. Intel joining Elon Musk's TerraFab project, a chip manufacturing effort for Tesla, SpaceX, and XAI. It aims to produce a huge amount of computing power every year. Intel's partnership would help accelerate that. Shares of Intel about 3% higher. And Bill Gates will reportedly appear before the House Oversight Committee this summer. Punchbowl reporting Bill Gates will sit down for a transcribed interview about Jeffrey Epstein on June 10th. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. It's a Bloomberg Business Flash. We return to Bloomberg Businessweek Daily with Caron, Massar and Tim Stenovec.
All right, Amy, so appreciate it. Hey, every day, tons of things related to artificial intelligence. Just today, we've been reporting out Anthropic, letting tech firms access a more powerful unreleased AI model to help prepare for possible cyber attacks that might result from the company making the advanced AI system more widely available. It's an initiative. It's called Project Glasswing. It's with Amazon, Apple, Microsoft, Cisco Systems, and a bunch of other organizations. And basically, Tim, they're going to get access to this new model from Anthropic called Mythos to hunt for flaws in their product and share findings with industry peers. So it sounds like a collective, and they're going to be collaborating on some level.
Are you having trouble keeping up with like all of the different iterations that we're hearing from this company ahead of a possible IPO?
Yes, and yes.
Okay, well, also on AI, the president of the New York Fed, John Williams, spoke to Bloomberg's Michael McKee earlier this morning at the New York Fed. Check out what he had to say.
I think a lot of CEOs have said, well, we're past that. So now we just have to navigate a world with higher uncertainty, make the decisions that make sense, make the investments that make sense. And you hear about that a lot with AI and investments in AI. So I think we're kind of in the second stage, if you will, of responding to uncertainty. It's really about, well, okay, we need to make decisions. Let's move forward.
John Williams of the New York Fed with Michael McKee a little earlier on AI investments. Great to have with us Sastry Durvasula, TIAA's Chief Operating, Information and Digital Officer. He joins us here in the studio. Sastry, good to have you on the program. We all know TIAA, more than a century-old retirement fund for teachers and other professionals. Carol and I were talking in the newsroom a little earlier. It's a basic question, but I think a really important one to set the conversation. What does the Chief Operating, Information and Digital Officer do day to day?
So I lead all the global technology for all of our businesses. Principal businesses are retirement services, which was the genesis of TIAA when it was founded by Andrew Carnegie 100 plus years ago. Wealth management business, which is our retail business, and our asset management business called Nuveen, where we manage close to $1.4 trillion in assets. So global technology, global digital capabilities and client experience, and global operations across all three businesses. So one way I always talk about is part of my team actually cooks the meal in technology and products and experiences. The other part of the team actually consumes the meal because they are serving our clients, whether it's participants or plan sponsors or consultants that we work with. Yeah.
Well, a big part of the task involves deploying AI and that technology across the organization, not just for people within your organization, but for customers you serve.
Yeah.
Which one is sort of like the priority right now? Is it on the consumer-facing side, or is it on the internal side to really get productivity figured out?
It's both. Definitely it starts with the client.
Okay.
So our clients are institutional clients, right? So we're a large B2B firm in that sense because we work with all the higher ed and healthcare clients in the United States. On the global front, in our asset management, we have a lot of institutional clients that we work with. So we work with institutional clients. Then it comes down to the millions of Americans we try to help with our lifetime income solutions, which is our participants. So it's more consumer on that side and then institutional on the other side. But then to be able to service them, we need our internal associates to be equipped with AI. So I do believe that we got to start the work internally first, which is what we've been doing for the last year and a half, 2 years. We put AI in the hands of every colleague in the company. So we have our own proprietary platform called Gate, and a generative and agentic intelligence technology. And we put it as My Gate in the hands of every colleague. It started with 300 people in a pilot mode. Now we have the entire company of associates using that. Because to be able to serve the clients, we need to experience that first ourselves, but we have some client-facing capabilities that are live in production as well.
Sastry, it feels like the conversation around AI is moving increasingly from these large language models to vertical data sets that are really, catered to a specific industry or an entity. Talk to us about that. If that's the case, that, it's not going to be just about these big data dumps of everything, but what's going to matter to you and your client base is a very smart data set that pertains to them.
Yeah, because, you're basically trying to rewire the company with AI, just like what we've done with the internet, with our, with mobile, et cetera. So When you try to rewire the company, what you need is the industry depth. TIAA obviously has decades of codified knowledge and wisdom and insights and data assets that we have proprietary insights into and proprietary capabilities for. So what we're doing is building this large language model agnostic platform, so that's obviously plugged into all the tools that companies that you just mentioned earlier in the prior segment. And we're basically leveraging those industry capabilities with our data assets in a secure way and providing intelligent insights. So for instance, when we serve our clients and the call comes in, our customer service professionals who are on my team have a screen, and they actually have AI agents giving them information in a secure way so that they can actually give all the way from there, Carol, to giving empathetic communications. We have an empathy agent. I know it's counterintuitive to talk about, but you're calling in with a transaction or a complaint, and we are trying to serve that, within time. But then we want to be able to give you the right level of empathetic communication as well. So the empathy agent is actually prompting the care professional, even drafting the email based on that transaction that we are serving to give you an empathetic solution, because we're dealing with retired participants here, so they need empathy. The other example I'll give you that's live in production at scale is what we call our scam AI detector.
Yeah. So
longevity is on the rise, which is a great thing for humanity. So which means we have more older adults that are our participants who are retired. They are the most vulnerable population from a financial fraud and cyber attacks point of view. And the cognitive decline is also on the rise in older adults. So that's the problem we're trying to solve. So when you have a retired professor who's getting a lifetime income paycheck from us and getting scammed by all these artists that are out there, whether it's impersonators like IRS agents, I'm from Microsoft IT desk, or romance scams and all kinds of scams, we have realized that AI is the best capability to deploy at scale at this point.
How though?
Yeah, that's what I was
it's actually looking for signals.
Yeah.
So for instance, these are real life participant examples where a participant gets a call saying, we're the IT support. We found a bug in your computer, and then lures them into getting into some website and then asking them to give the information. And the next thing you know, another impersonator comes and says, I'm from the FTC. We need to protect you. We need to move your assets. Now we're getting a call into our call center. These AI capabilities are detecting that there is fraud involved. There's a potential scam here. And then it actually activates the whole chain of agents to the point, this is the best part, at the end of that, there is a human in the loop for everything, right? So we also activate a call to the trusted advisor or trusted contact that this person may have and engage them in the conversation. And in fact, we have real life use cases where our participants are saying, TIAA saved my bacon.
Will you come back soon?
Yes.
Okay. We've run out of time.
Sastry Durvasula, TIAA's Chief Operating Information and Digital Officer, here in the studio. Coming up next, more on the markets and stocks on the move. This is Bloomberg.